This is Matthew Cratter from Trady University, and today I have a video for you that I think you're going to find quite informative and quite fun. I'm calling it Bitcoin and Rich People Problems, and it also includes a special bonus at the end where we're going to be talking about the future price of Bitcoin. So by rich people problems, I mean something like this. My kids can't hear me calling for them because my house is too big. But we're going to be talking about a particular kind of rich person problem, which is having a huge load of cash that you need to invest. So this is not modeled based on myself, but this is a general model, and I've certainly encountered a lot of people like this. I have $100 million that I need to invest. And the reason I need to invest it is because I don't know what to do with it right now. I already have all the consumption items that I need. I would like to give it to a charity at some point in the future, but I don't have a good charity lined up, or I don't like the ones that are available. I'd also maybe like to invest part of it into a productive business, but I don't see any opportunities at the moment. So I just need to park this money. I need to park $100 million, and I need to park it somewhere where it will maintain its purchasing power. So I don't want it to lose purchasing power. And so when the time comes to spend it or donate it, it's not able to buy me what is currently $100 million worth of goods. Now, of course, you can just give it away. Here's a quote from Matthew 19. It's easier for a camel to go through the eye of a needle than for someone who is rich to enter the kingdom of God. This is, of course, a possibility. But if I were to do this, the video would end right here. So I'm going to move on and look at the various places this 100 million could be invested. There's obviously high yield savings accounts, and these get you yields anywhere from about 1% to up to about 1.5%, 1.6%. And so they're still fairly low rates. And the problem with this is that CPI inflation is closer to 8 or 9%. It might even be higher than this. And so there's this huge gap. If you're earning 1.5 or 1.6% and inflation is 8 or 9%, you're losing purchasing power over time. You're not keeping up with the rate of inflation. So storing this in a high yield savings account isn't going to work for this reason. It's also not going to work because there are limits to the FDIC insurance for these savings account, up to $250,000 per depositor. If you do it with your spouse, you can get it up to $500,000. But this isn't nearly enough to invest $100 million. There are also sort of private banking solutions where they might give you 1 or 2% if you go to Goldman Sachs or UBS or one of these banks. But you run into a similar problem where the yields or the interest rates are so low that you don't really make any money after inflation. So this is one reason that a lot of wealthy people invest in Treasuries as a way of parking their capital, because you don't have to worry about FDIC insurance. We can see here that as of the end of the day, if I wanted to invest this for a year or two, I'd be getting something like 2.83%. So it's also not enough. It's not a high enough interest rate to keep up with inflation. So just investing in cash doesn't work. High yield savings accounts, U.S. Treasuries, which are backed by the full faith and credit of the U.S. government, also doesn't work simply because it doesn't keep up with inflation. So it looks like I have to look at other asset classes. There's real estate, of course. We're assuming that this person already lives in a nice house, and so maybe they already have 2 or 3 or 4 houses. Maybe they want another house. Here's a beautiful looking house in Beverly Hills. It's currently for sale, $87.5 million. I'm sure you could get it for $80 million in this environment, and 31,000 square feet, 12 bedrooms, 20 bathrooms. It's absolutely gorgeous. The problem with it, though, is it could be a fun place to live in. But again, we're assuming that you maybe already have a house like this because we're talking rich person problems. The other problem with this is, of course, it makes you a huge target for thieves and hucksters. And if there's ever a French Revolution, you're going to be the first to the guillotine, etc. The other problems are, of course, the carrying costs, which will detract or subtract from your investment returns. There's annual property taxes. Using a 1.25, 1.3% California property tax, I estimate the taxes for this property are about a little over $1 million per year. And so you're bleeding that. At the same time, you're bleeding your insurance premiums that you have to pay. You can imagine what the insurance would cost for a house like this, especially if you wanted to buy earthquake insurance for it, which can be extremely expensive. And then there are the basic maintenance costs, cleaning, general maintenance, replacing the roof, replacing leaks, landscaping, and then of course security costs. You can imagine that this is a difficult property to protect and guard, and you probably, if you have this much money invested in it, you really want 24-hour security, both for your own protection and for the protection of the asset. So the problem with a large house like this, it's like a battery leaking energy. It's probably going to go up over time. These houses have traditionally gone up over time, especially in areas where there's limited land, like in California or in Beverly Hills. But you're still leaking energy because you have these huge carrying costs that probably come to a few $1 million per year. So that's a problem with real estate as a place to park your $100 million. If you're finding this video helpful so far, I'd ask you to hit that subscribe and like button. Maybe share this video with a few friends as well. That would really help out the channel. So we've rejected cash, US Treasuries. We've rejected high-end real estate for the problems involved. There's always fine art. You could buy a Picasso. Here's a Picasso that sold in May of last year for $103 million. Not the most beautiful face I've ever seen, but it's obviously a unique work of art, and it's by Picasso, so it has this value, this scarcity value. Painting is beautiful, but if I keep it at my house, I'm going to have some carrying costs. I need proper security. I need to maintain the temperature correctly. I probably need a special room or container for this. I need to control the humidity, etc. And then if I'm ever traveling, I have to worry about it catching fire. And if my house catches on fire when I'm traveling, I hope someone grabs the Picasso. It's quite expensive, I imagine, as well, to buy annual insurance for this. And then you have the general problem of just protecting it from burglaries, etc., and people trying to steal it. And when something has a value of $100 million, you could spend $50, $60 million trying to steal it, and you'd still come out with a nice, handsome profit. So this is the problem with having something like this, which is very portable. It's easy to destroy, and it's easy to move around. So the other alternative is you could buy it and then have a museum hold it for you. They could display it for you, and you'd still retain ownership. The problem then is you have to worry about their insurance coverage, their security, any sort of counterparty risk. And then what if the government, what if other criminals seize it? So it could be a headache in that way as well. So we've gone through cash, US Treasuries, real estate. We said what I wanted to add is that not only does it have these maintenance costs, but it's also very expensive to buy and sell. You usually pay these costs only as a seller, at least in the US, but they can be anywhere from 6 to 8%, usually 5 or 6% commission. And then there are various title costs and various costs involved in selling it. Also, it could take years to sell. So real estate, especially a house like this, not very liquid. There are very few buyers in the world who have the capital to be able to purchase something like this. So it may take a couple years to sell it. And then when you want your $100 million back, you might not be able to get it back quickly enough just because the house is just sitting there not selling, maybe because the economy is bad or billionaires are having problems, something like this. Same problem with fine art, with a Picasso. Very expensive to buy and sell. If you sell it at Sotheby's, you have to pay them a commission. Also could take years to sell, so also not a liquid investment as well. There's other bonds, there's other fixed income, there's munis, there's corporate bonds, there's high yield bonds, junk bonds, there's mortgage-backed securities. All of these currently pay a yield that is below the rate of inflation. So these will not be good ways of preserving your capital. When the yields are below inflation, you're still losing purchasing power every year, in the same way those high yield savings accounts and US Treasuries were losing purchasing power every year. That leads us to stocks and the stock market as another asset class, another place to park our $100 million. We can take a look at companies like Johnson & Johnson, Meta, Facebook, United Health. These are all companies that trade for somewhere between $400 and $500 billion. If you're investing only $100 million, it wouldn't be a problem to over time build up a position in one of these companies. These are some of the largest market cap companies in the world. You're going to see why I picked this particular market cap in a second. The problem with this is, especially if it's a long-term investment, if it's a short-term investment, obviously stocks can move around in value. If it's a long-term investment, these companies might not be around in 10 to 100 years. They might be, but they might not. Also, the dividend yields that these pay are not great. They're anywhere from 0 for Facebook to 3% or so for Johnson & Johnson. Then there are stock indices. You can buy an index like the S&P 500 or the QQQs, the NASDAQ 100. These also don't pay a great yield at the moment, but they're very easy to invest in, especially with an ETF. They're fairly low cost. This has an expense ratio of 0.09%, only pays a dividend yield of 1.38%. So you need it to go up. You need the stock market as a whole, or the S&P 500, to go up by approximately 7 or 8% here per year to keep up with inflation if CPI inflation stays where it is, in order that your total return, in other words, price appreciation plus dividend yield, helps you to compensate for inflation. Traditionally, the stock market has gone up something like, or the US stock market has gone up something like 10% a year. There have also been major stock markets that went to zero. The Russian stock market went to zero after the Russian Revolution. German stock market went to zero a few times, I believe, after World War I and World War II as well. So that's a problem with betting on a country and its stock index. Nevertheless, in the last 20 years, the S&P 500 and these other stock indices, whether in the form of ETFs or futures or mutual funds, have become a savings vehicle for the rich, as well as for everyone else in their retirement accounts. If you have a 401k or an IRA, chances are you can invest in the S&P 500 or a mutual fund or ETF that tracks the S&P 500. Now, this is not a bad inflation hedge. Obviously, the price can move around, but in terms of a long-term inflation hedge, if most of the underlying companies can raise their prices in line with inflation and cover their increased expenses and input costs, or their increased labor costs and maybe commodity costs that are input costs, then they will do well if they're able to pass on these increased costs to whoever their suppliers or their labor is. The problem, though, if you have a lot of inflation, you can end up with lower profit margins. If they're not able to cover their increased input costs, you could also have these higher interest rates as a response to inflation, higher interest rates as a response to inflation, leading to lower price to earnings, lower valuation multiples like the PE ratios. So those are risks in an inflationary environment. And in the inflationary environment of the 70s, stocks traded at very low PEs. They currently still trade at high PEs. So this is a risk. Multiple contraction is a real risk for investing in equities. In addition, you have operational risk at all these individual companies. You have jurisdictional risk. How is the U.S. going to regulate them? Regulatory risk, tax policy risk. Even if the company is doing well, you might end up with it doing too well, and you end up with something like a windfall profits tax risk, which is currently happening. It's currently a threat to U.S. oil and natural gas companies in the U.S. They had a very difficult decade where they didn't make any money, and now that they're making money again, politicians want to seize their cash flows. So these are all the problems that come with investing in equities. And the other problem is, if you hold stocks, you hold them in a brokerage account, they can be seized. Your brokerage account can be seized. If the government's mad at you, if they accuse you of violating the law or something like this, especially if you live in a country not like the U.S., where there's maybe a dictator who can just decide to seize your assets, as is currently happening in places like Russia, for example. So that's a problem with stocks. We were talking about stocks that had a market cap of roughly $400-500 billion. That brings us to Bitcoin, which has a similar market cap. It's a surprisingly low market cap for what it is. And I'm going to argue that this, of course, is the best place to invest that $100 million. And it has a similar market cap to one of these large S&P 500 companies. Here are the good things about Bitcoin. Bitcoin is peer-to-peer money. You can send it to anyone, anytime, without needing anyone's permission. It's very easy to store. There are no property taxes. It's very easy to self-custody. You don't have to buy insurance for it. You don't have maintenance costs. You can store it on a hardware wallet. You can store it in multi-sig, and it's basically free to store. You also don't store it in an account. You store it yourself. You do self-custody, so it can't be seized in the same way that a house can be seized, or a painting like Picasso can be seized, or a stock brokerage account can be seized. Bitcoin cannot be frozen, cannot be confiscated, and also it has this real scarcity. It cannot be debased by central bank money printing. In addition, it seems to hold its value quite well over longer term time periods, 2 to 5 year periods. And so in this way, it's fairly similar to stocks. It can be volatile. But if your holding period is long enough, and so if I need to park my money, park my $100 million for something like 2 to 5 to 10 years, stocks are probably a good place, and Bitcoin is probably a good place as well. You could have a drawdown while you're waiting, but if they continue to behave in the way they've been behaving, you probably are able to keep up with inflation. One way of looking at the sort of intrinsic value or the long-term value of Bitcoin is to look at a chart of the 200-week moving average. So this is a chart of Bitcoin versus the US dollar. We can see this blue line, which is the 200-week moving average. It's always been going up. We're currently trading below it, which means Bitcoin is probably at a very good deal right now. The last time we traded below it was in March and April of 2020, very briefly. And now we're back down there. But the important point of this is if you look at the 200-week moving average, it helps to filter out a lot of the noise, and you can sort of see this steady appreciation of Bitcoin from 1600 here of the moving average in 2018 to 21,000 right now in 2022. So let's do a thought experiment now. What would happen if Bitcoin became a place for rich people to store their wealth in the same way that they store their wealth in the S&P 500 and ETFs or mutual funds? Right now, or at least as of the end of January, it's probably a little bit lower now, but at the end of January of 2022, the total value of all the 500 companies that are in the S&P 500 was about 40 trillion. So maybe now it's 35 trillion, something like that. But this gives you a ballpark figure. So I thought it'd be interesting to say what would happen if Bitcoin were valued as a retirement asset class in the same way that the S&P 500 is valued. Now, the S&P 500 was not always treated as this retirement vehicle. This is something that happened in the last 20 years. So what we want to, and this is one reason it's so overvalued, it trades at these high multiples, because it basically is a place to park your capital that's not bonds and that's not cash and that's not real estate. So what if Bitcoin became a similar asset class? It became a store of value in the same way. And again, store of value means it does not mean that it doesn't fluctuate. The price of gold fluctuates, even though gold is a store of value, a good historical store of value. The price of stocks value fluctuates quite a bit, but it's still been a very good store of value. And the S&P 500 stock indices are used as a store of value by wealthy people and by people who are saving their capital for the future. So what would happen if Bitcoin achieved a similar market cap to the S&P 500? Well, if we take the current market cap of the S&P 500, 40 trillion divided by 21 million Bitcoin, there are probably fewer Bitcoin now because a lot have been lost. There are estimates that the number of actual Bitcoin that can be accessed is closer to 15 or 16 or 17 million. But let's assume it's the full number. If it's fewer, then this would make this number even larger. But if we do this calculation, we end up with the value of Bitcoin per Bitcoin at about 1.9 million. So almost $2 million per Bitcoin. And if you make that adjustment for a smaller number of coins, 17 million coins, you'll get a market cap well over you'll get a price per Bitcoin over $2 million per Bitcoin. I want to argue, and this is what I'm arguing in this video, that Bitcoin is already worth more than $1 million per coin, just that the market hasn't figured it out yet. It hasn't figured out in the same way that the market in the early 2000s hadn't figured out the value of Google, the value of Amazon, and the value of some of these other internet companies, simply because the future was still uncertain and people didn't quite know whether it was going to succeed. So I think Bitcoin's in a similar situation. Looking back on it, there was almost no way for Amazon to fail, especially with Jeff Bezos at the helm. And I think if you've watched my other videos, you'll know that I believe that there's almost no way that Bitcoin can fail as well. So I tend to think of a Bitcoin, if I use a Bitcoin, if I buy a Bitcoin, I tend to treat it as if it's already $1 million coin. Market hasn't figured this out yet, but this is a very, very special asset. This is money that you can store yourself, as we said, at basically zero cost. You can send it to anyone in the world, including yourself. You can send it to yourself in another jurisdiction. So if the US becomes hostile to Bitcoin, maybe you go to Singapore and your Bitcoin ends up there. It's much easier to take Bitcoin to Singapore or to El Salvador or to some island in the South Pacific. It's much easier to take Bitcoin than it is to take $100 million worth of gold bars, a Picasso, a Beverly Hills house. These are obviously not portable. The other thing about Bitcoin, it cannot be debased. And if you understand how the network works, how the incentives work, how the nodes run the software, you realize that there will never be more than 21 million Bitcoin. The incentives are not there for the full nodes to run software. That increases this cap and changes the issuance schedule of Bitcoin. So if you don't understand that, you have to take my word for it. At this point, you can watch, I've made videos about that subject. But basically, Bitcoin is this very hard form of money that cannot be debased. You can print up a lot more euros and dollars, but you can't make more Bitcoin in the same way that you can't make more Picassos, genuine, authentic Picassos, and you can't make more land in Beverly Hills or on the coast of Hawaii. So this kind of scarcity really matters when you want an asset that's going to preserve its value over time. As we said, try leaving town with $100 million worth of gold or a Picasso. Also, try storing $100 million worth of gold in your house or trusting another company to store and insure it for you. You take on counterparty risk. You have to pay the insurance and storage costs. So this is why Bitcoin is so interesting. It's a lot like gold, but it's much easier to store. It's much easier to verify, and it's much easier to move around. If we want to value Bitcoin using gold and say that Bitcoin is basically a much more user-friendly version of gold, the current market cap of gold is about 11.5 trillion. If we do the math, if we say it's worth 12 trillion and divide that by 21 million Bitcoin, we end up with a price of about $500,000, $600,000 per Bitcoin if Bitcoin as an asset were valued as a monetary good as gold is. Now, it's very important to understand that only about 10% of gold's value comes from its uses, comes from its utility as an industrial good. It's used in iPhones, it's used in various electronics, etc. But this is not why gold is valued at 12 trillion. That other 90% is a monetary premium that is afforded to gold because it is this historical store of value. And so that's one reason that gold has such a high market cap. It's not just, I know there'll be people who say, well, you can't make jewelry out of Bitcoin, so it's not useful. But the real value of gold is its store of value properties as a non-debasable asset. And this is where Bitcoin really is gold 2.0. So we've come up with two estimates here. We've come up with Bitcoin worth about 2 trillion a coin if we value it like the S&P 500, or about $500,000 per coin if it achieves a valuation in line with that of gold. Now I want to end this video by pointing out that I gave this a funny title, but rich people problems really are important, not just for the future of Bitcoin as an asset, but it's also rich people problems are the problem of saving excess capital. These are problems that affect everyone, anyone who has an excess where they spend a little bit less than they earn. So even if you're not rich, even if you don't have these rich people problems, you still need to find a way to keep up with inflation and store your wealth safely, especially if you'd like to retire at some point. If you don't want to work until you're 80 years old, you need to find out a way to store your earnings, your savings in a way that will not be debased by the Federal Reserve, that will not be devalued, that will not be confiscated, that will not be stolen, and that will not implode in value. If you stored your wealth, if you stored your savings in Luna or Celsius, you had all this counterparty risk, all this operational and algorithmic risk. You ended up getting wrecked, and your money is never coming back. So this isn't just a rich person problem. It's also a middle class problem and a working class problem as well. Wealth and savings matter both for individuals and for human civilization. Wealth and savings is how you support your future self, your retired self, or your disabled self where you're no longer able to work, either because of physical or mental problems. It's the way you support your children or your future children, your grandchildren, or your future grandchildren, and give them a step up in life. But it's also much bigger than that. It's important for the culture, and it's important for the civilization, because savings, a stockpile of civilizational or cultural wealth, is the way that a culture or civilization funds new exploration, new startups, whether exploring the solar system or exploring the bottom of the ocean, inventing new technologies that can save lives, whether in biotechnology or in other forms of applied tech, also saving the planet, whatever that means for you, cleaning up dirty soil, cleaning up dirty water, cleaning up toxic waste, planting more trees, whatever saving the planet needs for you. So this is why it's important to have savings. This is why it's important to have an excess of earnings that is not destroyed by central bankers, that's not confiscated and spent frivolously by governments. And this is why Bitcoin really matters as an asset for the future of human civilization, as well as for your own financial future. And I think this is one way to look at it, how a wealthy person tries to figure out how to allocate $100 million. This provides insights and lessons that we can all use for our individual finances, as well as for the finances of our country and our civilization, human civilization as a whole. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.